Hello and welcome to the SCR webinar. With us today is Lisa Jones, Principal and owner of Carolina Flood Solutions LLC, which provides a comprehensive array of consulting services in floodplain management, mitigation, flood insurance, and flood mapping specialties. She is a trusted advisor for NAR and SCR on all things flood insurance. Lisa comes with over 25 years of floodplain management experience. She has served as chair of the Association of State Floodplain Managers, held a position as state NFIP coordinator for the SCDNR, has served on numerous federal task forces, and has even testified before Congress on the subject. She has been with us before as a keynote speaker at the SCR hosted South Carolina Flood Summit, has been a SCR webinar presenter in the past, and has spoken and consulted for NAR and numerous other realtor associations across the country. Thanks for joining us, and now I'm going to turn it over to you.
Thank you for having me today. Welcome everybody to the webinar, and thank you for taking your lunch hour to learn about what's going on with flood insurance and the NFIP reform. What we've learned now is that everyone needs to have a basic education of flood insurance. So flood insurance education just isn't for insurance agents anymore. We've learned is everybody needs familiar with some simple acronyms and definitions, the types of coverage available, coverage amounts, the fact that optional deductibles are available, which will lower premiums. You need to learn about elevation certificates in the community rating system. We're talking about flood zones. We're talking about high-risk flood hazard areas. That's where flood insurance is required under the mandatory purchase requirements. Flood insurance is required in those high-risk zones or any zone that begins with an A or a V you see listed here on the screen. The low-risk flood zones begin with B, C, or X, or D. Those are considered non-special flood hazard areas. Flooding can still occur in those areas and does, but they are low risk to flooding. Mandatory purchase requirements are the lending requirements where flood insurance is required for any mortgage that is for a property that's located in a zone A or B. The types of coverage the amount of coverage required can vary from the amount of the loan, so they could be overinsured or underinsured depending upon how much equity they have or their down payment that they had in the property. But we always want to make sure they're properly rated. If the structure is not located in zone that begins with an A or a V, it's optional, then the lender can still require flood insurance. And they can get a very cheap, simple policy called a preferred risk policy. If you want to know what the flood zones a property is in, you can go to a number of sources. First off is the FEMA's Map Service Center. They can get that information also from a community official, current homeowner's elevation certificate, or their NFIP policy declarations page, the flood hazard determination form, or a prior letter of map change if that's been issued. That just kind of gives us an overview of some of the things you're going to be looking, need to be familiar with. So let's talk about the NFIP reform on pre-firm subsidies. These are those properties that are older. I recently did an article in the South Carolina Builder Journal, which is the current magazine that's out, and you can get a copy of that online here at scbuildermags.net. Bigger Waters Reform was the original Reform Act was implemented in July 6th of 2012 was when President Obama signed it. We got really excited because it reauthorized the NFIP for 5 years through September 30th, 2017. But with it also comes some painful triggers in trying to deal with the debt of the program and making it financially stable. At that time, it was about $28 billion in debt. And the Bigger Waters Reform Act was intended to provide that stability for the program and bring structures more into actuarial risk. Some definitions you need to be familiar with both the BW12 and what I call Grim Waters 14 are going to be pre-firm structures. Those are structures that are built prior to the date of the initial firm for a community, and they have not been substantially improved or substantially damaged. Subsidized rates are those rates for pre-firms buildings that were beginning with zones A or in zones D. and not rated with an elevation certificate. Full risk rate structures are those rated with an elevation certificate, and for structures located in zones A or B, and they do reflect the true risk of the property. And then non-primary residence, that's a building that was going to be lived in for less than 80% of the time by the policyholder. That 80% has now changed to 50% beginning June 1st. So if we look at Grim Waters, which is the second Reform Act that just passed this year on March 21st, that really repealed a lot of the painful BW12 provisions that were in place. So, for example, a property going to full risk rate at the time of a real estate transaction. This bill really focuses on affordability and continues that financial path through of stability for the program, but it created some new subsidies. Grim Waters 2014, or GW14, is known commonly as the Homeowners Flood Insurance Affordability Act of 2014, but if I had to say that 20 times throughout this presentation, I would not get anything else in. So I'm going to refer to it as BW12, Biggert Waters 12, which is the original Reform Act, or Grim Waters, or GW14, which is the Homeowners Flood Insurance Affordability Act of 2014. So if we look at that, the Biggert Waters, as you can see here, is in the box. The provisions that are scratched out are really what the Grim Waters repealed of the bill. So if you're looking at the slide there, you'll see that the two things that said if you had a pre-firm structure where the primary residents are not affected until this building was sold or they purchased a new policy, those two provisions were struck by the Homeowners Flood Insurance Affordability Act of 2014. The other thing that was struck was post-firm buildings and buildings not a special flood hazard are not impacted by Section 205. Grim Waters instituted two surcharges. One's $25 and the one's $250. The $25 surcharge will be applied to all policies across the board, both pre-firm and post-firm, for primary residence. And the $250 surcharge is added for non-primary residences and the business community, non-residential structures. But as you can see here, we still have provisions in here that Grim Waters didn't repeal, and that is if the policy lapses, or if there's severe repeated flood losses, if the property owner refuses a mitigation offer, or if the structure is either substantially damaged or substantially improved. But it did institute also a maximum increase of 18%. That is new, and that's not a bad thing. So it restored the pre-firm subsidies. So structures that were not insured at the time the Reform Act was enacted or sold, they're now allowed to go out and buy a flood insurance policy without having to go to full risk rates. So if you know anybody who was impacted by this and decided either to let their policy lapse or didn't buy a policy, now's a good time for them to step back into the market. So let's talk about rate increases for these subsidized policies. We're going to have gradual rate increases for subsidized policies instead of that immediate move to full risk rates when the property is sold. So those are capped at between 5 to 15% a year, but no more than 8% per policyholder until full risk rate premium is achieved. And we'll talk in a minute how we're going to determine that. The exceptions to that cap we just went over are properties that were subject to the Biggert Waters 25% mandatory increases for non-primary residences, businesses, severe repetitive loss properties, including those cumulative repetitive loss properties, and structures that were either substantially damaged or substantially improved. They are not covered by the cap. So that 25% that was in the Biggert Waters is still existing for the properties now that we've got the Grim Waters Reform Bill passed. So those properties that were getting the 25% increases will still see those 25% increases until they hit full risk rate premium. If a community loses its CRS rating for one reason or gets downgraded in class, then they're not subject to the cap as well. If the structure is misrated, the cap does not apply. Or if it's a premium decrease due to a deductible or increase in coverage, the cap does not apply. So let's talk about the continued phase out. So we talked about rates under BW12 would increase 25% a year for pre-firm buildings and special flood hazard areas in Zone D until they reflect full risk rate. So effective January 1, rates started going up for non-primary residences. And effective October 1st, 2013, we started looking at commercial building or non-residential properties and structures that had been repetitively flooded. We're looking at the surcharge. You know, we mentioned earlier about the surcharge. The Grim Waters bill has a surcharge applied to all policies until the pre-firm subsidies are eliminated. And that's the language from the law. So that surcharge is going to be around for a while. So it's going to be $25 surcharge on primary residence, single-family residences, and that includes 2 to 4 family residences, and $250 on all other. That would mean non-residential, apartment buildings, commercial, any type of business, or a rental property. It's not considered premium, so it's not subject to the cap on the rate increases. And the first year that the surcharges go into effect, and the surcharges are scheduled to go into effect beginning October 1 of this year. So when a policy renews on or after October 1, 2013, they're going to see a greater than 18% increase in the first year's premium because of the surcharges being added. So there'll either be an additional 25% surcharge or $250, depending upon the type of structure, type of policy. So we talked about primary residence and principal residence. Primary residence we talked about a minute ago. I said if it's a primary residence, they had to live in there 50% or more of the time. Bigger waters merge the two. Principal and primary are the same under bigger waters. But under Grim Waters, they changed the primary residence to 50%, making them different. The only FEMA still has the principal residence definition, and you'll need to know that because if a structure's primary residence and they live there 50% of the time, but it's not the principal residence, which means they live there 80% of the time, at the time of claim, they will only be paid actual cash value of their claim rather than replacement cost value. But either the insured or the insured spouse needs to live there 80% of the time to receive replacement cost value. Non-primary residence, effective May 1, this definition changed to 50% that the spouse or the insured spouse need to live there. They can qualify for pre-firm policy as long as the subsidized rate, with that subsidized rate, as long as there's no lapse in coverage. So how do we determine full risk rate premiums? Well, in order to determine the full risk rate premium, we're going to have to get an elevation certificate. Those are completed by either a registered professional land surveyor or an engineer in the community. Then once they get that elevation certificate, they can take that elevation certificate to their insurance agent and ask them to give them a quote for full, for what, using that elevation certificate, and that'll tell them what the full risk rate premium is. So when we're looking at a 25% phase into full risk rate premium, how do we know when that's going to be met? So if you look here at these examples, I have example 1 here where LFE means lowest floor elevation. You subtract that, the base flood elevation. In this instance, we're going to have -3 feet. So the full risk rate premium we've calculated is going to be $7,922. As you can see here, as we go through, so do I have an arrow on this, the pointer?
Yeah.
Let's see, where's that at? I'm sorry. Okay, so if we're going through here, there, we got the existing policy is $2,968, and then the next year we have an increase. It goes up to $3,719, and then all the way down to year 3, we're getting up now to $5,797, and then year 4 we hit $7,226. Year 5, we are now looking at hitting the threshold of where we've got our return on our investment, that it would be, it makes sense to mitigate or implement, the being rated with an elevation certificate. So if we're looking at the amount of premiums, when I say return on the investment, I'm talking about what do I need to do to reduce the flood insurance cost, and how much is it going to cost me to do that? Do I really want to be paying, $7,922 every year for flood insurance over the course of 10, 15 years? Or is there something I can do that I can do now that would be cheaper, inexpensive, compared to paying that flood insurance for the life of the structure, knowing it's going to go up 18% a year? So that's one thing right there to consider. The second example here is if we have an elevation certificate and we take it to our insurance agent and we determine that there's no difference between the base flood elevation and the lowest floor, the full risk rate premium is going to be $1,722. So we'd want to use that beginning the very first year. We'd want to be rated using that elevation certificate. That's why it's so important to find out early on whether or not we want, what the risk is and what the true full risk rate premium would be, because it may end up being cheaper. And just to note here, if we had not turned in the elevation certificate to the insurance agent, we had not gotten one, by year 9, our flood insurance would be up to $17,691. It doesn't stop unless we turn in that elevation certificate. The Grim Waters Act and Biggert Waters as well instituted private flood options. With the reinstatement of the private market, reinstatement of the subsidized rates, we're not sure what impact that's going to have on the private interest of the private market getting into selling private market policies that are the equivalent of the NFIP. Florida's been very aggressive in encouraging that private market solution, and South Carolina's look at some of those same things going on here. So we're just going to have to wait and see, but there are private market options available out there, and if the person cannot qualify for or afford a NFIP policy, private market policy might be the best option. However, I just want to note one thing. Unlike health insurance, that if you have a health insurance policy, it's recognized by everybody because you have continuous coverage. If you drop your NFIP policy and go to a private market policy, then try to come back to the NFIP, you will not be recognized as having continuous coverage. So it's not the same. So just understand that if you drop your NFIP policy, you may not be able to come back at that subsidized rate. You may have to go to full risk rate premium if they try to return. So the policy lapsed under Biggert Waters, you had to go to full risk rate premium. Effective May 1st, 2014, you can have that policy reinstated with the grandfathered rates. And everybody wants to talk about refunds. And I have one client who's going to be a very happy camper. His flood insurance premium for the first year was $8,000. And the seller paid that $8,000 as part of the closing deal. So FEMA is restoring those pre-firm rates and refunding excess premiums for policyholders who purchased a building, a pre-firm building, that sold or it was policy lapsed after July 6, 2012. They may be entitled to a refund. So we're going to revert back to those pre-firm rates beginning October 1, 2014. And FEMA is going to use those rates to calculate the refund that anybody may be entitled to. Guidance is going to be issued by the companies in July of this year. And the refunds will start in the fall after the new rates are published and they come out with the rules and how the companies have to do these refunds. So if you sold a house after July 1st or July 6, 2012, on or after July 6, 2012, then you'll need to contact those clients and let them know, hey, you guys might be entitled to a refund. Now, not everybody's going to get a refund. They're going to get a refund of the difference of what they should have been paying as the subsidized rate versus what they were paying. In the instance of my client, the existing policyholder was paying around $460. They paid $8,000. They're going to get a substantial refund. But the key is to know that not everyone's going to get a refund. The write your own companies are going to get to earn, keep the commissions and their expense allowance for the work that they completed because they've done work on those policies. So those will be allowed to retain those, but the policyholders will get a refund of the premium. So know that's coming. Effective May 1st of this year, just last month, they stopped those rate increases that were being triggered by bigger waters. So any structure that, or any new policy, if the structure is sold or there's a new policy written for a subsidized pre-firm structure, they're going to get to have those rates, use the new rates. They'll be used the rate tables from 10/1/2013, and FEMA's developing the guidance on the refund process. So if they, again, paid that high premium, they're going to get a refund back. Let's talk about grandfathering. When we talk about grandfathering, we're talking about structures that are post-firm that were built after the flood insurance rate map is in effect. Bigger Water said, okay, if we have a new map, those rates are going to increase 20% a year for 5 years until they hit full risk rates. And that was a huge impact. So if the base flood elevation went up or the zone changed, the grandfathering would be phased out over a 5-year period. And some of those instances, the premiums were going to be significant. That was scheduled to be implemented this October, and thanks to Grim Waters, this has been stopped completely and eliminated. So it's going to provide a new pass. So now that when we have a map revision, we're talking about map revisions in insurable buildings, we're going to see 1 of 6 changes occur. Either there's going to be no change, or they're going to modify the structure from a low risk to a high risk, or a high risk to a low risk. So they're going to be moving it from an A to a V into a B, C, or X, or from a B, C, or X into an A or V. We're going to see the designation of coastal A zones. That's what you see Limois there. It's not a dance, but it's the area of limited wave action. And that's where we have waves between 1 and 3 feet. It's important that we map these areas because FEMA was finding structures that were in these areas were damaged. And so they're trying to set these zones up for future implementation of building code changes. You can see a change in the base flood elevation, which is the risk that associated with the structure, or a change in the vertical datum. But we've made improvements in map accuracy. We're using LiDAR data now, so we've got better topography. We're using different and updated models to run the hydrology and hydraulics. But map accuracy costs money, so it's never going to be perfect. And the mapping program that FEMA has is underfunded to meet the expectations that you guys have out there, which you guys want 100% bulletproof, error-free maps, as so does everybody else. But that's just not something that's going to happen under the current budget. When we talk about grandfathering, we're talking about structures that are newly mapped in special flood hazard areas. The first year policy is going to be at the PRP rate. So when I say PRP, I mean preferred risk rate. This is that simple policy that you'll see on the news program, on the commercials, that starts at $129. And then subsequent years will be based on the same method used to eliminate that pre-firm subsidy, which is going to be 25% a year. Limited exceptions where the 18% cap applies for premium exceptions. It does not, the law does not address changes in special flood hazard areas where you increase the BFE or it moves from zone A to zone V. It's only those structures that are moving from B, C, and X into a zone that begins with an A or V. And grandfather policies are not entitled to refunds because they were not pre-firm subsidized. So we talked about preferred risk policy. This is that one that you see advertised on TV. It's your peace of mind type of coverage for structures that are located in zone B, C, or X. The community has to be participating in the regular program. It has a very varying degrees of fixed coverage available. You can get contents only coverage or building and contents coverage, but you cannot get building only coverage. But you have to meet a limited loss history eligibility requirement that says you've not had more than so many losses or a combination of losses in federal disaster assistance. If you meet the threshold, you would not qualify for preferred risk policy. So let's talk about other changes that occurred June 1, 2014. Other residential building limits went from 250,000 for dollar for building to $500,000. So that's a big change. And then contents coverage stayed at 100,000. When I'm talking about another residential building, I'm talking about building coverage that for a apartment complex or a long-term care facility where the stays are 6 months or more. The primary residence was redefined, and again that changed from 80% to 50%. The minimum deductibles are revised, so there's going to be some changes in deductibles beginning June 1. And the policy disclosure, Congress ordered that we increase the font size, and so the page count is going to increase. So what was a 15-page booklet, maybe 36 pages now. So those are some other changes you're going to be seeing. Grim Waters 14 also addressed affordability. Some of the rates are going to be rolled back. The provisions are being implemented as we speak. Structures are going to have a slower path to full risk rate. Minimize the number of policies with annual premiums exceeding 1% of total coverage. That's kind of an interesting concept of what they want us to do. Maximum premium increase dropped from 20% to 15% and 18% for any one class. It allowed the maximum deductible to go from $5,000 to $10,000. This has not been implemented yet and will not be implemented until sometime in 2015. We're thinking around May of next year. Well, the FEMA will allow the deductible to be increased to $2,000, from $5,000 to $10,000 for the maximum deductible. It also said that the residential detached structures are exempt from the mandatory purchase requirements. So, for example, if you have a main structure, a house on the property, and they have a detached garage, the lender now is only required to apply the mandatory purchase requirement to the main structure and not to the detached garage. That'll be a relief to some, especially when the secondary structure on the property was a storage shed. They can still purchase it, but it's not mandatory. And it also requires FEMA to identify other mitigation efforts that the policyholders can do to reduce their flood risk and their rates. And the issue of monthly payments is still in grim waters, but it has not been implemented yet, so that people could pay their premium monthly rather than in one lump sum. It also set up more money in the study on affordability and a proposed framework. One thing that we haven't talked about, and that is businesses. What is a business? FEMA has a category called non-residential, and that encompasses businesses, churches, and anything that doesn't fall into the single family or 2 to 4 family category. FEMA does not have a business definition or category yet. Just like until recently, they didn't have a primary or non-primary subcategory for residential. So FEMA's going to have to go into rulemaking, and they're going to have to define what a business is. And once they do, then they'll be able to implement the rate increases for businesses. But until such time, you're probably going to see the rates capped at the 15% for non-primary residences until they come up with this subcategory. I'm sorry, the 25% until they come up with a subcategory. FEMA's priorities that they're working on right now are going to be the refunds, the rate changes, and the surcharge implementation. Mapping is their second primary priority, and then promoting mitigation. That's telling people what they can do to lower their flood insurance premium. And then the last thing that they're focusing on, the Grim Waters legislation called for, is a flood insurance advocate. Flood insurance advocate is kind of what I've been doing with my business. People are having trouble with their flood insurance policy. They think they're paying too much, or they're having difficulty. The agent's having difficulty. They'll hire someone to come in and help them. FEMA's been tasked to set up a flood insurance advocacy office so that people could call and ask for help on their flood insurance policy, find out about mapping, find out about mitigation, and things like that. So that's wonderful news for policyholders, that they'll have someone to turn to for assistance. But if you want to know more about the flood insurance reform, FEMA has a website. The link here is on, you see on the screen. You can log on there and get up-to-date information on the NFIP reform. Transferring or assigning an NFIP policy is, we've been talking about this for a long time now. This is the way to go. If you had a property owner, seller, or buyer who assumed a policy from the original owner or the previous owner, it's really helpful now as we try to roll back the rate increase. We know what the previous policyholder was paying. So that's going to be very helpful. But we always want to sign or transfer policies anyway, because all the documentation really flows from the old owner to the new owner. And that is very helpful and provides also continuous coverage, which is very important in COBRA zones. And grandfather rates, again, are going to be available until further notice. The subsidized rates have been reinstated. So we're doing really good. When we talk about rating steps, these rating steps, we're going here. This is a very complicated process to rate in NFIP policies, and there are errors made. So we really want to, pay attention to things. See if there's some way we can save money if something was misinterpreted, and that's kind of what I help do. But if we look at this as an example, this is an example of mitigation. Take the elevation certificate. As you can see here on your screen, right down here in A8, you see the 1,058. That's the number of, that's the square footage of an enclosure. And we look down here, so the total number of net open area for vents, and that's 315 square inches. So we're short on our requirements, because the requirements say we have to have 1 square inch for every square foot of enclosed space. And if we don't have that, if they don't equal, or C isn't greater than A, then the structure is going to be rated as a slab on grade building potentially. But it's got to be there, and in any attached garage it has to have vents as well. Smart Vent is one of our sponsors today, and we're going to talk a little bit about venting here to focus on this mitigation effort. This is a typical gable end that you'll see. This only provides 35 square inches of net open area, and this is what happens when we don't have enough vents in a structure. The foundation wall will collapse. This happened. This is a slide from Sandy. This is what we don't want to happen. These vents also become clogged with debris because they don't allow the debris to flow through. That puts hydrostatic forces, pressure against the wall as well. So it results in collapse. So if you have a person who can come by and install the vents that are right for the job, these are smart vents. Smart vents provide 200 square inches of an open area. And in this instance, we've got 200 here. So we have 400 square 400 square inches here that are covered. And this is the type of really what you want to see, because this allows the water to flow through unobstructed, and the debris can pass through as well. And they stay closed, so you don't have to worry about them opening and closing with temperature. They're not temperature sensitive. And they do have screens on there so the bugs can't get in. Those are the typical things that everybody's worried about. So Smart Vent, again, is one of our sponsors today. And if you look at the C now, the surveyor can correct C to reflect the total square inches in A8 and A9, and then they will pay a cheaper insurance rate. I have one client who I talked to yesterday who his base rate was $4.60. Once he installs the vents, it'll drop down to 91 cents. So it could be a huge savings. But again, vents may not be the only thing they need to do, so it's best to consult a professional before making any recommendations, because you'd hate for them to install the vents and realize that that wasn't the only problem that they had. It was something else that's going to be more costly to fix. I had one client who spent $2,000 on vents and then figured out that wasn't his problem. So again, make sure you check with a qualified professional, and that everything's being looked at and just not vents. But again, vents are a huge savings if that is the problem. So living in the floodplain as we wrap this up and we start to take questions. The most important thing is to know the risk, to look at the FEMA maps. For example, you can get down Forest Acres City Hall if you're here and look at the maps. Um, you need to know what flood zone you're in. You need to get an elevation certificate. That'll tell you what the full risk rate premium will be eventually. You want to get a development permit required if you're doing any land disturbing activity. You want to buy flood insurance in the event you don't have it, even if you don't think you need it, because 1/3 of the claims we have come in BC and X zones. And if you have a policy already, you need to make sure that they're rated properly and that they have the right type of policy. I had a insured who had an other residential policy and was limited to $250,000. He should have been a non-residential policy, and he could have gotten $500,000 in both, which he does have currently. So the most important thing is to get that elevation certificate, figure out what the risk is, and see if there's any way you can reduce your risk. And just know that the NFIP is an evolving program. The rate increases for subsidized policies are going to go in effect along with the surcharges on 10/1/2014. That all the studies that the Grim Waters called for and the Biggert Waters called for have not been completed. So these are talking about affordability. A lot of those studies dealt with affordability. Map accuracy is going to continue to be an issue, so it's really important when we get those preliminary issued by communities that we and FEMA that we review them. We're going to have rating mistakes. If you look at the mistakes I see with my clients, Biggert Waters or Grim Waters isn't fixing those. Use all the available tools you have, and we need to look at developing new tools to assist you. And be prepared to advocate for changes in the next reform bill. You know, this bill's coming, the program expires September 30th, 2017. We have 3 years really to work on what do we want in the next reform bill. So be patient, proactive, and stay informed. And these are some suggested actions for you. Get to know your community floodplain managers. They can tell you whether property is in the floodplain, out of the floodplain. They can also tell you what things you can do to mitigate flood losses. Learn the basics about flood insurance. A couple things we went through today. You want to pay attention to and review those preliminary flood maps that come out. Question high premiums that don't make sense. If it doesn't make sense, it may not be accurate. Become a community rating system activist. And what do I mean by that? If your community is not in the community rating system, talk to your local elected officials about getting enrolled. If you are enrolled in the CRS program, then don't stop at the current class. A lot of communities are a class 8 or class 9. There's no reason why we can't get some of these communities down to a 5 or 6, where you're getting a bigger discount. Know who to turn to when you need help. That's the most important thing. If you don't understand something, ask questions and know who your trusted advisor is, who you can turn to for assistance. And contact any clients that were impacted by the Biggert Waters 2012 bill, because they may be entitled to a refund. What great news. You could call up and say, hi, I just got some news. You might be entitled to a refund come this fall, your flood insurance premium. So with that, I'm going to take any questions that you might have.
All right. Why the higher increase for rental or commercial properties? How are they a higher risk? Isn't a flood a flood?
Very good question. For some reason, Congress decided that the single-family structures and 2 to 4 family structures that are residential were different than business properties or non-residential properties. Those are the 2 classes that FEMA has right now, is residential and non-residential. And for some reason, Congress and FEMA decided to implement the change there. I do not understand the rationale behind it, but I think that they felt like they were affording, be able to the the risk higher, to pay the additional risk.
How can buyer agents help protect their buyer clients when considering purchasing a residential property that is raised on stilt pilings, but the current owner has enclosed the lower level carport with walls to create a living space?
Can you repeat that again?
How can buyer agents help protect their buyer clients when considering purchasing a residential property that is raised on stilt pilings, but the current owner has enclosed a low level carport with walls to create a living
Yeah,
space.
when you've got somebody who has done something, the question is, if they have a house that was built on piers, posts, piles, or columns, and the current owner's gone in and constructed an enclosure underneath there and put living space in there, and the new buyers coming in and they're getting hit with these high premiums because that enclosed area. The only thing that you really can do is look at the mitigation options. And what depends on what zone it's in, but it may be that they have to rip that enclosure out and restore it back to what it was. But again, before you do that, we need to ask a few more questions. We need to know what zone it's in, and we need to know the size of the enclosure. But that's a very, very good question. So that's an instance where you want to consult a qualified professional. We also need to know if it was done with or without a permit. I mean, that matters too.
Are there large flood insurance rate differences if the deductible is raised? Is there a rule of thumb for the ideal deductible versus cost/coverage?
Is there a rule of thumb on deductibles for and basically the standard deductible right now is it was $1,000. Now it's going to $1,000 or $1,200 depending upon the amount of coverage you have. Basically, the rule of thumb, the higher the deductible, the lower the premium is going to be. In some instances, if you have a $5,000 deductible, you're going to see about a 15% drop in your flood insurance premium. That's pretty significant. But most lenders are not going to allow you to have a $5,000 deductible. So it's really a negotiation between what the insured can afford and what the lender will allow. So if they can afford a $5,000 deductible, I always encourage that. Next year, the deductible will be increased to $10,000. But again, it's a negotiation between the mortgage company and the property owner. So it's just whatever they're going to be, whatever they will allow. That was a very good question.
Who/what are community floodplain managers? How do we find them?
Okay, who are the community floodplain managers? Community floodplain managers are typically going to be the building inspections office. There'll be somebody there that's designated, or in the planning or zoning office, but sometimes in a smaller community it's going to be the town clerk or the fire chief. So you just need to go in and ask who issues the floodplain building permits, and they'll be able to help you that way. But it's going to vary from community to community, and there's no list that really provides that to us.
If a home or business is located well below the base flood elevation, are rates just going to the full risk rate premium that we were seeing before GW14? Some of those rates were outrageous.
No, these high rates that we've seen are gone. If the property was sold, and they went to immediate full risk rate, that's done. They're going to have the grandfathered rate restored, which may be around $400, $500, $600, and they're going to see gradual increases over the years until they hit full risk rate premiums. So that's done. Where we are going to see a higher increase is going to be in secondary, non-primary residential structures. They're still going to go up 25% a year until they hit that full risk rate premium. So it's really important now that we figure out what the full risk rate premium is early on. So if I figured out I could spend $2,000 today, and rather than paying $3,000 a year for flood insurance and have that going up 25% a year for the next 10 years, I will get a return on my investment almost immediately. Because when you add, like I said, when you add the events, it makes a huge difference in some instances.
Okay, and someone said, just to repeat the questions again.
Okay.
Why higher rates for non-primary house?
Okay.
What do they think that the occupant can do to stop flooding if they are not, if they are a permanent resident?
So they're looking at non-primary residences, and so non-primary residences have up to $500,000 in coverage available. So the question is, why single out non-primary residences for higher rates? And typically, when you're talking about high non-primary residences, you're talking about a bigger investment and more risk for FEMA to insure. And that seems to be actuarially where they're having difficulty in balancing what the risk is and charging an accurate premium. So they've actually looked at it actuarially, and they just think that they need to start charging more. So they're choosing to use non-primary residences as the avenue for increasing that risk at 25%, because they also feel that they can also bear that burden better, the 25% risk, than the owner of a primary residence. There's some affluency issues, I think, that they're looking at too. Who can afford it? Single family homeowner versus a business or rental income property.
Um, what effect do these floodplain rules have on houses built on a concrete slab?
What effect do these rules have on houses that are built on concrete slab? That's a very good question. The rules have been in place for a long time. The rating's not changing. Really, we're looking at is educating property owners about mitigation. Are there things that we need to do? There are a lot of grant programs out there that FEMA has and others have for rehabilitating structures. And so when we talk about rehabilitation, we're talking about mitigation. You can raise a slab on grade structure. And so if you look at the cost of what the flood insurance is going to cost over a period of time, it may be easier to do a demolition rebuild or an elevation project on some of these smaller homes. But the rules really aren't changing. It's just that we are implementing the rules that are in place. It's going to determine whether or not they're pre-firm, subsidized, or grandfathered. Either way, they're going to get to keep the current rate, but they will continue to see increases until they hit full risk rate premiums. And again, it's going to depend on what zone they're in and what the relationship to that structure is to the risk, base flood elevation.
How can realtors monitor flood remapping updates in their local areas, and how can they communicate mistakes, and who takes these complaints?
Okay. The question is how do they monitor flood map updates in their area, and how they communicate mistakes? That's a very, very good question. Again, that goes back to establishing that relationship with your local floodplain manager. He's going to know when those maps are being released, because they're going to be they'll have some sort of like little public hearing, so you will be aware of it. But how do you communicate mistakes? After the maps are released, there'll be about a 30-day window for everybody to kind of look at it, and then they're going to start this what we call a 90-day appeal process. And during that 90 days, you'll be able to submit any information concerning the maps that need to be changed or corrected. But that's a very, very good question.
Are you receiving reports of lenders requiring unnecessary flood insurance coverage?
Am I receiving reports of lenders requiring unnecessary flood insurance coverage? Sometimes we get lenders who are requiring flood insurance in both BC and X zones, and that makes it hard because, of course, they get the preferred risk policy, but they are mandating the coverage. The one thing I'm seeing more of right now is, for example, is overinsurance. The most the NFIP is ever going to pay on a claim is $250,000. So, for example, and this was one of my clients, I had a client who bought a house in Savannah, Georgia, and it was $250,000, and they required $250,000 worth of flood insurance coverage. Well, you think on the surface that makes sense, but what they're saying is that the land has zero value. That the full sale price is attributed to the square footage of the house. And we know that that is not true. This house in particular was on the Intercoastal Waterway, and if you looked at the tax assessor's website, you could see that they valued the land at $100,000, meaning that the structure was only worth $150,000. But the lender was requiring flood insurance for $250,000. And FEMA will never pay that much out in claims unless that is the true replacement cost value for that structure. So that's a very good question. That's the one thing I'm seeing right now is a lot of overinsurance.
Can you comment on machinery on ground level for raised homes, such as air conditioners, elevators, heating systems, pumps, pools?
Right. The Can I comment on the electrical and mechanical equipment such as hot water heaters, HVAC that are on the ground of a house that's raised? You know, if it's in the enclosure, it's covered. So if the hot water heater is in an enclosure underneath an elevated building, FEMA will pay for that. And if that enclosure does not meet the requirements, you're going to pay an enormous amount for an $800 hot water heater. And so we need to make sure that the utilities are elevated and that those enclosures meet the requirements so that they can have cheap insurance, such as flood vents. We want to make sure that the flood vents, that we have enough of them and that they're right size and right types that permit the automatic entry and exit of floodwaters. And it's very important that we know that in V zones, in A zones, it's a venting requirement. In a V zone, it's the size of the enclosure. In a V zone, we cannot have an enclosure that's equal to or greater than 300 square feet beneath an elevated building. Any enclosure greater than that, it's automatically going to be a slab on grade building. And then the last thing that's become very popular is residential elevators. Residential elevators have become very popular with FEMA and they in the community, but FEMA has triggered them as a high risk because the cabs will down, people will get out, the flood hits or the power goes off and the cab is unable to return to the higher level. And that makes it an insurance problem for them. So they've determined that any structure that has an elevator is automatically going to be a submit for rate determination. And that could mean higher flood insurance premiums.
Actually, another person had a question because they have an elevator and they were wondering if there's anything they can do to get their rate reduced.
Okay, that's another good question because I'm working with FEMA. I have 2 clients right now that I'm working with, and I'm working with FEMA right now to see if we can't come up with a design that would satisfy them so that they would not load additional additional rates on that elevator. So I'm working with them right now to come up with a viable solution. We've talked about, can we have a battery backup or something that would bring the car back? So we're kicking around a lot of different things, and we were just talking about it last week. How do we do this so that we can get rid of the elevator problem as far as being a loading factor?
States are coming out with new floodplain maps. Can this change everything?
When states come out with new floodplain maps, can that change everything? The only thing that changes is, we talked about 1 of 5 things that could change in our earlier slide. Risk does change. When the risk doesn't stay the same. When you buy a car brand new and you drive it off the lot, it's going to deteriorate over time. You're going to drive it into different, it's not going to stay on the car lot where it's subject to not having any damage. You're going to drive down the road. The hazards are going to change as you drive down that road. And it's kind of like flood hazards. Over time, flood hazards are going to change. Some of the risk is going to go up and some of the risk is going to go down. And it's just going to depend on where that structure is located and how close to the water it is. Very good question.
A non-primary resident that the owner is using as a rental property for approximately 90% of the year, is that considered primary or not primary?
The insured or the insured spouse, in order for something to be considered, the question is, is a rental property primary or non-primary if it's rented 90% of the time? And the answer is it's either the insured or the insured spouse has to live on the property 90% of the time or more, or it's be 50% or more of the time. If they're not living there 50% or more of the time, then it is considered a non-primary residence under FEMA's rules.
Is it best to get an updated flood certificate if you have an older certificate that does not give all the information to correctly rate the building?
It is, the question is, I have an older elevation certificate. Do I need to get a new elevation certificate that has different elevations or different questions on it in order for a structure to be properly rated? We can use the old elevation certificates. Elevation certificates run between $350 and $600 or $800, and that's a lot of money to have to put out. the underwriters can use an older elevation certificate if nothing has changed on the building. So in other words, there's never been an addition, or I haven't done any excavation on the land around the structure. The older elevation certificate is still valid and can be used. And so you can save that expense. If you think that there's something that's not right about the elevation certificate and you want to go to that expense of getting one, you're more than welcome to, but it's not necessary.
How do we determine what the new full rate premium will be?
How do you determine what the new full risk rate premium is going to be is the question. Again, the way to determine that is to get an elevation certificate and take it to an insurance agent for a quote.
Will the new map increase the minimum flood map elevation, such as 14-foot or 15-foot?
Yeah, the question is, will maps increase when the new flood maps come out? Will the base flood elevations of 14 feet or 15 feet, will that go up? Some instances it's going to go up, some is going to go down, and some is going to be no change. There really is no set answer. It's just going to vary by the terrain of the property, whether or not they had a good base map when they did the mapping last time, because they're using LiDAR data now. It's going to depend on the storm surge data along the coast that's being implemented. They have modeling for that. It's just going to vary by community with community. Some instances we see 1,500 new properties going in a flood hazard area. At the same time, we see 1,500 new property, older properties moving out. It just depends on how accurate the previous map was and how long it's been since you've had a map, map in between map updates.
This person said that they heard that FEMA is considering using a 30-year flood map instead of 100-year. Is that true? Yeah, that's true.
So there's a question about, the FEMA's, is FEMA considering changing the standard from the 100-year flood map to a 30-year flood map? The standard's always been the 100-year flood map, where we have the 1% chance of a flood occurring in any given year. And we've gotten away from using the 100-year term and now calling it the 1% chance flood. And the reason being is of the perception. But in using the term 30-year, FEMA will often model things that they'll model the 500-year or the 30-year in addition to the 100-year, and those are for planning purposes. But their standard is always going to be the 1% chance flood or that 100-year event.
The person who had asked about the certificate before, they're asking if the certificate doesn't reflect the correct venting or does not show venting at all on the earlier certificates.
Okay, so the question is, if we have an old elevation certificate, doesn't have the vent questions on it, do I need to get a new elevation certificate to address the venting, that addresses the venting or not? No, you do not. You can supply pictures and a description of the vents. So the pictures will show us the number of vents. You can say that there are 5 vents now, and do the calculations on a sheet of paper and provide that to the insurance agent. But the photographs will show the type of vent and where the vents are placed, and that they're correctly located. The vents have to be no higher than above grade. We all know what the width of a brick is, or the width of a cinder block, and we can count. So there are ways to do that without having to get a new elevation certificate.
Are owners required to report all flood events, or should owners use judgment about reporting in order to avoid being labeled a property suffering repeated flood events?
Okay, should I avoid should you avoid filing a claim, I guess is the question, is if you get flooded, do you have to report that event to avoid becoming classified as a repetitive loss property? I think everybody's going to know when the flood event occurs, because it's 2 or more properties is the standard. So it's typically going to, it's not only going to be you affected if it's a flood, and really you have that flood insurance as a benefit. If it's a small something that's happened, you may not want to report it, or you may, but you frankly you have that flood insurance policy as a benefit. Most flood events are going to be significant enough that it's going to be more than just the carpet getting wet.
That's pretty much everything.
I think that's all the questions we have. Do we have one more round for questions?
Someone wants to know if you have a Google Plus account.
Do I have a Google Plus account? I do not have a Google Plus account, but I'll consider adding that. How's that?
Yeah, there you go.
But I am on LinkedIn, and I have a Facebook page and a website. Any other questions? I want to thank you today and for attending this webinar, and I want to thank again SmartVent for their sponsorship. Consider visiting their website at www.smartvent.com. Thank you again.